Hello, everyone. My name is Sam. I'm a licensed mortgage broker, realtor here in Florida, and welcome to your first time homebuyer blueprint webinar. I hope that you guys will enjoy this webinar and will actually learn something new or refresh your knowledge when by the time we finish this webinar. Let me share my screen and so you guys can have better understanding what I'm talking about. Uh, First of all, I would like to thank you everyone who were able to join it and whoever will join in a little bit. And would like to start by a little bit talking about my background. It's been about a little over 21 years ago. I came to United States from Armenia. It's a small country with only 3 million population located in Middle East. I had the luxury and privilege during my work experience in United States to work in different industries and learn a lot. I started in a hospitality business, then I became a general manager and acting area manager at Whataburger in Texas. When I moved to Florida, I opened my logistic business. I always had this entrepreneurship mindset, but everything changed when I decided to purchase my first home here in Florida, right? Uh, the frustration, all the whole process was very long, and actually the communication between realtor and a mortgage broker was broken. It's not all about I was able to purchase it or not. I actually at the end was able to purchase my home. It's not the question. The entire process was very frustrated, and I realized that it should not be this way. There are opportunities in this industry, and especially with my math background and all the information during the process that I was trying to inquire and understand, I kind of started to like the whole process and decided to uh, get my license first as a realtor, and later on I got my license as a mortgage broker, and now I'm acting and as a realtor and a mortgage loan originator. And everyone has their own choice. They can hire and mortgage brokers and a realtor and try them to work together for their journey of becoming home ownership in United States. However, sometimes some people prefer to use just one person who can do both. It's just a preference, nothing mandatory, but there is two things that you need to understand. When you are looking to purchase specifically your first home, you need two main people on your team: your realtor and mortgage broker. And we will talk about that little bit later. Before we fully start our webinar, I want to introduce you our today's agenda. Now, by end of this webinar, you should learn and better understand how to calculate your income and your mortgage payment and your affordability, because that's very important, and learn the entire home buying process step by step. Avoid the most common home buying mistakes that people make. Why learn and understand why you may be heard a lot of times today's market, even with high rates, are opportunities for a lot of people. Understand why we say that, and at the end we will get into live question and answers. Just to let you know, you guys probably whoever just joined it don't don't know that this webinar is actually recorded. But at the time when we get into question and answers, I will stop the recording and we can chat uh, without recording, because I do understand that a lot of people may have questions, and they feel that could be more personal than anybody else who will later on will watch this video will want to hear. So we will uh, stop the recording at that time. Now, without any delay, let's move forward and. Let me explain why I told you why the two people that will be the most important team players at your journey when you're trying to purchase a home are mortgage broker and a realtor. Because if they can communicate together, if they know what they are doing, everything should go smoothly. I cannot tell you that it will not be stressful. It depends every person and personality. Regardless, whatever your mortgage broker and realtor will do, the entire home buying process sometimes will be stressful. However, they can make every effort possible to make it as smooth and as stressless as possible. Now, when you are choosing your mortgage broker and realtor, make sure, it's my personal advice to you guys, choose wisely. Your mortgage broker and realtor has to be knowledgeable in their industries, and they also must, and it's absolutely must, be transparent. There is no single reason, it's my personal opinion, but unfortunately I do see a lot of the times in the industry that you are calling and uh, they are not answering the phone. There is no single reason in the world, unless there is something extraordinary and tragic happened, that they cannot call you back. We all have families, we all have other obligations, and that's understandable. We may not be able to answer the call right away, but we should be able to return your call and answer any questions you guys will have. Because for you guys, purchasing a home is one of the biggest, if not the biggest, uh, investment of your lifetime, and you will have a lot of questions. Your realtor and mortgage broker should be able to answer every single question you will have. If they don't know the answer, they should do their everything possible to find out the answer for that and get back to you guys. Now, let's move to our first topic, understanding how much home you can afford. Now, it's very important to understand when you are looking at and doing your calculations, Zillow, Realtors.com, and other platforms, when you are looking to the homes, they give a basic calculations that you can see how much will be your mortgage payment. That's fine. Unfortunately, there is no single calculation exist nowadays yet that pulls up proper taxes, very close gives you very close estimate how much the insurance for that property will be. It's very hard to do because to understand how much your property insurance will cost you to give you very close to real number estimate, a lot of factors are involved. It depends what year is your home was built. Does it? What year is the roof? Does it has a hurricane shutter, especially in Florida, or hurricane impact windows or not? A lot of factors are involved, so it's very hard to give the estimate based on when you're doing the initial calculations. But you should have the idea that most of the homes, if they are 20 years 20 years and older, the insurance on single property homes will be between $4,000 to $8,000, and you can just take the average when you do your calculations. But it's important again to understand what you think after you do your calculations you can afford based on your income. It's not the same what banks thinks you can afford. Besides the credit score, besides all other factors, bank implemented debt to income ratio in order to feel safe. Now, a lot of people may think if they use, even right now, they may renting and they are paying 60, 70% of their income towards the rent, so they can afford to pay towards the mortgage same percentage. Yes, you may think that way, but banks don't feel comfortable to lend you money uh, at higher risk for them. The debt to income ratio is actually the percentage of your income that banks that should include your liabilities, that should include full housing payment, that banks will feel comfortable to lend money besides the down payment, everything. So that debt to income ratio is variable as well. Depends what type of loan you are doing. Depends what are you a first time home buyer or not. There are some differences on that debt to income ratio percentage. For example, on a first time home buyers, if some other factors are favorable, banks will go as high as 57% to approve you for the mortgage. But traditionally, the conventional loans, all other non-QM loans, they prefer to be less than 50%. So just to explain you this more detailing, first, what you have to do, you have to calculate your full housing budget. You saw the property, you know approximate rate, you calculated your principal and interest. That's great. Now, on top of the principal and interest, you will have to pay taxes. You will have a homeowner's insurance. You will have homeowners association, HOA, or if you buy in a condo or townhouse, there will be it depends the legal structure of the those communities. Association fee or will be involved, and those are not cheap in Florida. At some places, your homeowners association can be even $1,500 a month, and that will affect a lot on your debt to income ratio. Now, to again, to calculate your full housing budget, monthly payments, you have to add principal and interest, homeowners insurance monthly, your monthly homeowners association or condo association fees, if there is any. If you put less than 20% down, you will have a mortgage insurance, which approximately, if you are doing conventional loans, it will be about 0.3% range of the loan amount. And or if you're doing first time home buyer, it's 0.55% of the loan amount. And add all those together. Now, besides that, DTI should include your liabilities as well. And what are the liabilities? Liabilities are your minimum monthly obligations that you borrowed from another place's money, and you are every month making the payments. Most of the liabilities will show on your credit report, but there are some that will not show on your credit report. What are the liabilities that not will show on your credit report? One of them is your IRS installment payments. If you own taxes to the IRS, you couldn't pay it in full, and you got in with IRS into installment payments, those will not show on your credit report when we pull the credit. However, every lender does an inquiry with IRS, and they will find out about that. So it's very important. Do not miss that factors. If it's not showing on your credit report, that doesn't mean you don't have liability from the eyes of the lender. It's very important to If you no, because nobody knows better than you whom you making payments or what and what your obligations that not showing on a credit report. So you should be honest to yourself and take those into consideration on when you're calculating your monthly minimum liabilities. Another thing is that lenders don't carry you on to your credit cards. You have a balance of 10,000, 20,000, or $50,000. That's really not the case. What they calculating, what we are as a mortgage brokers calculating is what's your minimum payment for that balance. Now it's $200 a month. Then we will calculate $200 minimum obligation plus what's on your other credit card. How much is your minimum obligations on that, and add all that together. Once you have, you don't forget your car payment. So, and even if you it's a very important issue as well. Maybe you have a car and you're calculating that, but if you co-sign someone to purchase a car, that's a liability to you too. It will show on your credit report. Now there are ways to exclude those type of liabilities, and that's why you have to talk with your mortgage broker, and they will explain you everything how to exclude. There are actually good ways to exclude, especially if you are just a cosigner, and so whoever you cosign, they made all the payments. Then it will be possible to exclude that liability. But don't forget that take that into calculation, because it's not 100% that you will be able to exclude it. Now, add your monthly housing budget plus all your liabilities, and the easiest way is just the multiply to 2. So if you all your housing budget and liabilities, for example, are $5,000 a month, so you should show at least $10,001 income. Otherwise, the banks will not approve you based on the DTI. There are some other ways to help to make to bring your DTI below 50%. Maybe you have $1,000 credit card balance and your minimum payment is $50, and you are on a verge of like little over 50% DTI. Maybe you should pay that $1,000, pay off that credit card balance, and your minimum liabilities will get lower, and you may get into your qualifying DTI ratio. So there are ways, but you should talk with your mortgage broker at that point, and they will guide you through once they see all the information in front of them. But for your basic calculation, don't forget your liabilities. Don't calculate only the principal and interest. Make sure you're calculating reasonable insurance, reasonable HOS, reasonable liabilities. And it's before I move forward to next topic, I want to tell you that it's very important when you're hiring a mortgage broker to guide you through and get you approved for the loan. They should ask you very specific few questions before they start. Where you are trying to purchase a home, what type of home you are trying to purchase. Are you considering to purchase a home if it's in a homeowners association, for example? Because when I, as a mortgage broker, for example, giving you a pre-approval, I need to know those factors. Because if you tell me I'm purchasing, I'm only going to look for homes that will not have an HOA. I'm not going to buy a house if there is even a $1 HOA. Then I will give you the pre-approval without taking into consideration your HOA fees. Nowadays, especially in Florida, almost 85% of the places you will have the homeowners association. If it's a single home, if it's a condo, you're always going to have the condo association fee. And those are not cheap either. They could range from $100 to $500, $600 on even $900 on single family homes. Depends what community it is. And just to give you an idea, based on the today's rates, every $100 is a purchase power given to you or taken from you, approximately $16,000 to $18,000. In other words, if I will not calculate homeowners association, at least let's say $200, $300 as golden average on your pre-approval, and I will give you higher pre-approval amount, but you will never get approved if you start looking at that price range homes where the home there is a $300 homeowners association, because that's right there about $45,000-$50,000 purchase power is taken out from you. You looked $700,000 house based on your pre-approval, but you realistically, because there is a $300 HOA, based on your situation, you only will get approved for $650,000. So if you got into executed contract and you didn't talk to your mortgage broker before submitting offer to get a green light, that will be a problem. That will be full of waste of the time. Now, hopefully this section was clear. Again, write down any questions you guys have. I will be happy to get back to you on this topic at the end and answer specific questions you will have. Now, let's move forward into our next topic, which is how to learn home buying process step by step. Now, your very first step should be getting a mortgage broker, honestly, not the realtor, a mortgage broker, because you want to get the full pre-approval. You value your time, value your realtor's time. Let's do not waste anybody's time. Let's get a clear picture based on your pre-approval range. What houses you at what price range of houses you should go start searching for. Your mortgage broker will pull your credit, will get all necessary documentations to verify your income, if you are a citizen, if you are a green card holder or non-permanent resident. Those are important factors also that may help a mortgage broker to determine your pre-approval, because if you are a non-permanent resident, a lot of lenders, depends the situation, they will fund you money. They will give you the mortgage, but they may charge you a higher rate. So your mortgage broker will understand the full picture before to give you your pre-approval based on the rates exist today. You need to kind of have an idea as a mortgage broker in this particular person's situation, what's the rates will be to give you pre-approval range. And why I am mentioning a range, because it's very different from house to house. I can give you $700,000 pre-approval, but honestly, because as I mentioned before, each house is different. They have different taxes for your full mortgage payment. They will have different insurance estimates. Each house will stand with it alone. Because if you have a $700,000 house that you want to purchase, but their taxes are $12,000 a month, a year, which means $1,000 a month adding up into your debt to income ratio. But there is an $800,000 house that has hurricane impact windows, and has only $3,000 property taxes. You may be able to qualify for that one versus the $700,000 house. Yes, don't be surprised, that's possible. Not always you can go by price, and that's one of the mistakes a lot of people do, and we will get back to it. Now, once you got your pre-approved range, you get your realtor, you start searching the home. That's a whole another process. You're going into showings, open houses. You like the house, you submit an offer. Hopefully, you get into negotiation and finalize the price and actually get executed on the contract. Executed into a contract means both parties agreed and signed the contract, and now you guys are bind it. You have end seller and you as a buyer. Now, that's when you and your realtor decided the terms into a contract comes into play. Well, there are a lot of deadlines on the contract. Very basic and first one, when you are in a contract, you're always putting a good faith escrow money deposit within 2 days, 3 days, or immediately with an offer. Depends how the offer is structured. Usually it's within 3 days after execution of the contract. Now that's your deadline. You should wire that money to the escrow account or to the title, whoever is going to represent on this transaction within those 3 days. That's one of the deadline. The next most important deadline is inspection deadline. Now, usually it's between a 7 to 15 days range. And nowadays, a lot of sellers prefer that you put as less inspection period as possible because they want to know if you are moving forward or not. And standard, I will say, when I do personally loans, it depends what day of the week is. If it's Friday, I will ask probably 9 or 10 days of inspection period, just because it's Friday, Saturday, Sunday in between, and you are losing 2 days. But usually, if it's during the week, I will ask 7 days, because I do have and every realtor has their own connections with good inspection guys, and they can arrange very quickly within 2 days to get the inspection done. Now, why inspection is very important, and I only put the inspection on this process circle, not the appraisal contingency or your escrow money deposit deadline, because first of all, let's understand, we are purchasing, it's one of a house. You went and look at it, but you cannot see a lot of details. Maybe the roof has an active leak and it's not rainy day, you don't see it, and they covered it up really good. So your inspector will do true detailed inspection and will get back to you with all the information they were able to find. Maybe the roof is let's say if it's shingle roof, the lifetime expectancy is 15 years, and it's been 14 and a half years or 16 years past the lifetime of the roof. And those factors are very important to determine how much your property insurance estimate will be. You may not, even if there is an active leak and there is no lifetime expectancy on a roof left, you will not be able to obtain an insurance. And listen to this very carefully. If you cannot obtain an insurance for this property when you are purchasing with the mortgage, forget about the mortgage. Your bank will not lend you money until it's corrected. Now, so that's your leverage with the inspection period, that you're going to find out more detail about the property. And if you found some critical problems, and let me be clear on one thing as well. You will always, if it's not brand new built house, even on those situations, the inspector will always find where even minor stuff, but they will always find something concerning, or and highlight it as a yellow. Like as simple as it could be, there is no, by the codes, there should be some kind of to bring you, in the kitchen or in the bathrooms, there should be a switch in this place with the breaker. And it's very easy fix, but those inspector will find out and they will put in a report. So very hardly you will get a report that there is everything is perfect. A lot of times you will see double type on your electrical panel. That's an easy fix too, but those things always will be there. Those are minor stuff that really you can ask to be fixed, but you can move forward and fix yourself. That's not that costly. But there could be a major stuff on the inspection, and based on those major stuff, you may come back and start negotiating a new price with the seller, and the whole negotiation process will start again. The coolest thing in Florida with the inspection period is that during the inspection period, you can back out and without even any reason and cancel the contract and receive your deposit back. You don't even have to pay and conduct inspection. You change your mind, you just submit within the inspection time frame written email to your listing agent and to seller, or depends if the seller has a agent or not, and notify them that you are canceling the deal. That you will receive absolutely 100% your deposit back, if again it is within an inspection time period. Even if 1 hour passed of inspection period, seller, it's up to seller's discretion. You are in default and you cannot cancel based on the even if there is an inspection issues. You should negotiate if there is an issue with this inspection time period. Now, once everything is cleared, you're moving forward with the purchase. Your mortgage broker comes in back. They have already your pre-approval, and they should know most of the stuff about your situation. But it's the time here is very important. When you get your pre-approval, we pull, as a mortgage brokers, we pull your credit. Depends from the lender, but standardly lenders wants to see 3 months. That credit pull is good for 3 months. So depends how long it took to find a home, how long it took you to do inspection, all the factors. It could be more than 2 months passed after you got your pre-approval, and that's enough time to some stuff to change in your personal life. So that's why mortgage brokers will re-ask and re-evaluate your situation at that time. And most likely, if it's more than 2 months, they will pull your credit again, because when banks want to see 3 months, it means at the time of the closing, the pulled credit should not be older than 3 months. So if it's more than 2 months and the entire process is taking more than a month, then most likely we have to pull your credit again. It's a standard everywhere, so don't be surprised, especially you guys as a first-time home buyer, why we are pulling again. That's lender requirements, and we have to comply with it. Now, your mortgage broker got structure the loan. They should have a good idea which direction they go with your specific situation, because if you are a W-2 employee, it's a different loan structure. If you are a self-employed or have a C Corp or S Corporation, calculating income calculus differently. Sometimes it will be beneficial to do a bank statement loan or P&L loan if you are self-employed. In different ways, your mortgage broker should explain you all that to you, and together with your approval to move forward with the specific loan that they tailor to your specific needs, and submit to the lender, and that lender's underwriter receives the loan and reviewing all the information. If your mortgage broker knows what they're doing, you will get your from underwriter your initial approval. And why it's not a final approval, it's initial, because even if you are proactive, you submitted every info or even the title, commitments, paperwork, everything from title that lenders are asking from the start. If the property by that lender standards is not qualifying for appraiser waiver, there will be appraiser waiver contingency there. Approval with contingencies means we are approving you this loan as long as you clear those contingencies. And your mortgage broker starting to clear as many contingencies as it appears there step by step. Appraisal contingency, let's say, will be there until bank orders the appraisal and appraisers comes back with this specific appraised price of that property. Why the appraiser is very important for the lenders? Because they will not loan you money more than what appraisal tells them the property worth. Right? If you got into a contract for $700,000 for a specific property, and the appraiser comes back $680,000, banks will tell you, you know what, we are approving you, but based on $680,000. So if you're putting 10% down, for us, the price of the house is $680,000. We will loan you out 90% of that $680,000. You can move forward and purchase at $700,000, but that $20,000 difference you have to cover out of your pocket. Now that's where it comes importance of a lot of times I speak this to realtors. Always put appraisal contingency with the contract. A lot of realtors, when there is a mortgage involved on the contract, there is a financial contingency. They think the financial contingency itself covers the appraisal. That's not 100% correct, because let me be very clear on this topic. When your appraisal comes less, banks will not deny you based on the appraisal. They, as I mentioned, they will say, we're still approving you. We will not issue the denial, but based on the appraisal value, you have to cover the difference out of the pocket. Now, if you don't have appraisal contingency and you have enough money on your bank account that you can cover it, of course you don't want to pay or overpay. But if you have enough money, you are not the type of the person, buyers, that they using their they will not have enough money, even $5,000, if that's the difference, to cover. Bank will deny them. If they don't have it, they will deny. Bank will deny them. They know based on not appraisal, but based on there is not sufficient money available for this transaction. That's how you can get away when the appraisal is higher. But if you have the money and lenders saw it on your bank statement, they will not issue the denial. They because denial means they cannot approve the loan, not because you don't want it. That's why they don't spend that money. It's very important to understand. Now, the seller will ask you, okay, you are out of your inspection period, everything. Show me the denial for your financial contingency. Otherwise, you are in default. And you can't have if I'm the seller, I will ask denial from the lender. I will not ask the denial from mortgage broker. Because one mortgage broker can issue a denial, I will tell you, go another mortgage broker that can approve. Depends how nasty can sellers get, because understand, sellers are very tied up on these contracts that exist. They have no way out of the deal, and once they are in a contract. You as a seller can get out and get your deposit back as a buyer. As a seller, you're tied until your mortgage, your buyer is not default or cancels the deal. You are stuck with them, and so they always frustrated, and they may get in that frustration can get into them, and they can get nasty in that regard. But you cannot blame them. You basically took that house, their house, out of the market. They are patiently waiting, and you just cannot do whatever you want. Wait 20 days and just say, mortgage broker, write a denial. I'm out because I don't want to pay $5,000 over appraisal fee. Now it again all depends at what type of seller it is. Now, back to my point is it's important to have appraisal contingency. Why appraisal contingency is important? Because it specifically states that if the house should appraise at this amount, what's on a contract. If it will not, you have the right to receive your it doesn't matter you get denial or you have enough funds or not. You have the right to cancel it, the deal, and get your escrow money deposit fully back. Unless you guys renegotiate and seller agrees to sell for $680,000 instead of $700,000. And realistically, no seller will not agree to not lower it, because if they will not lower, you're going to cancel it. They're going to start everything over. Who knows when they will receive another offer, even if they have backup offer and it's not a cash offer. And a lot of cash buyers don't want to pay over appraisal either. But the chances that someone will come and pay over appraisal, it's very slim. Now, they will not give it to you. They will cancel. Another person comes. The appraisal will come similar, and they have to lower again. Everyone gonna ask you to match the appraisal price. So it really doesn't make sense from seller's point of perspective to deny you. The only way they will deny that they really don't care. If it will not sell at that price, they don't care. They will not, rather do not sell it. The sellers are different. So it all depends. But if you have appraisal contingency there, which I always tell you guys, have it on your contract. That contract will not be valid if the appraisal contingency is mentioned on the contract and it's not signed. So that's your backup. You don't need to rely on a bank to issue denial, because not 100% of the time people will not buying with their last money. And they have one bank account with they show to the lender they have enough money, but of course you don't want to overpay it. So there are technical issues there, and that's why as a realtor I always put appraisal contingency. I don't care, even if it will be waived, good. Then it's good for you too. You're not gonna spend that $500, $600, $700 for appraisal, but I have it on the contract, and I'm protecting my buyers. Let's move forward. If once all the contingencies are cleared, bank will give you clear to close status. What's clear to close status means? It's very important to understand. It's just a green light for you that everything looks good as of right now. You can go ahead and schedule your closing with the title, and if there is anything if there is nothing will change between the receiving clear to close and the closing time, you're good to close. Why it's very important to understand? Because a lot of times, especially in Florida, when there are condo association and homeowners associations are involved, and you have to apply with them, and a lot of times you may have to wait about 30 days, and they take their whole 30 days most of the times to give you the approval of HOA approval. Title should not close you if it's a requirement until you have your approval from homeowners association or condo association. So I can close sometimes, depends the loan type, in 5, 10, or 15 days and get you into clear to close status. But if you have to wait 30 days, there is a 2 weeks, 15 days gap between receiving clear to close and closing scheduled, based on you are waiting for that homeowners association approval. A lot of things can change from bank's perspective and in reality as well. Maybe you quit your job. Maybe you switch to a totally different industry. That's a red flag as well. Maybe you deciding, okay, I have a clear to close status. Okay, I'm good. I'm going to buy me a new car that I will park on my new house, near my new house on a driveway. That's a big no-no. You should not do anything. And as a mortgage broker, I always tell my clients, do not apply even for $1,000 credit card during the process. Wait till it closes, you receive your keys, then you can do with your credit whatever you want. I don't care. But let's finish and close this deal. Because banks, within 2-3 days of the closing date, when it's scheduled already with title and confirmed, they will do the written or verbal verification of employment. They may soft pull your credit to see if they, and most of them do. It's not hurting your credit. That's why it's called soft credit pull, to check if everything, as you state, same before they transfer the money to title. So be very careful. It's very important. Clear to close status doesn't mean you are finally approved. Finally approved one means when they fire the money to title, you sign the paperwork, and the money was disbursed by title, and you got the keys. So be very careful. It's important. I've been in situations that I thousands of times told the clients, don't do it. They got clear to close status, and they went and bought themselves a new car, doubling their payment. Now, if you are not in a verge of DTI, your income supports it. It doesn't automatically mean you will get denied. It's just gonna delay the closing. Now the bank will pull everything back to underwriting process, re-verify everything, new paperwork submit, and then if everything looks good, they will still issue again clear to close status. But that's process, and that may take few days to week, depends the situation. Now your closing delayed. So it's important to do whatever your good mortgage broker will say. Now, the last step is, let's say everything you did correct, nothing major changed in your life during the closing, between the closing and clear to close. You are sitting with the title at the closing table, signing bunch of paperwork. For buyers with mortgage, it's more than 120, 150 pages. Don't be surprised. Once you signed, a lot of banks, title scans them to the lender banks. They review everything again, correctly signed and notarized, whatever paperwork needs to be notarized. And notarizing done at title does it. They have a notary license. And once the bank emails them, it's good to go to disburse the money. Everybody, seller receives their money, your realtor receives their money, mortgage brokerage receives their money. Everybody receives their money, and you receive your keys. Now, that's when all the fun starts. Everybody's starting to congratulate you, and you are homeowner eventually. That's the entire process. It took me more than 10 minutes to explain. Now, in reality, a lot of things are involved. So a lot of times you're going to submit one paperwork and then resubmit a new one. So all that depends on what type of person you are. It can get frustrated. But it's our job as a realtors and mortgage brokers to make this as smooth as possible. I like to explain every step to my clients. And some clients, they say, Sam, we trust you, just do it. We really, we don't want to know just to be, because we don't want to get frustrated. That's fine. But a lot of people, and those are more than people who don't want to know, they want to know at what step we are, what we are doing, why we need this paperwork, why we need that paperwork. You have to be, as a realtor and mortgage broker, very transparent, and if they need it, you have to provide it. Hopefully this was clear as well. I was able to explain this home buying process step by step, the way that you have more understanding now. And if you have, again, any questions, write it down so you will not forget, so you guys can ask me at the end. Let's move to the next topic, is the most common home buying mistakes people make. And I already mentioned few of them during this webinar already, but let me move quicker on this point. Starting with the pre-approval. You have to get the pre-approval. As I mentioned, you want to value your time and your realtor's time. Don't waste anybody's time, and you want to know everything from the beginning. As I said, there will be possibility that you may get approved on a higher price, but not on a lower. Depends what type of property it is, what type of taxes it is, and that leads to our next common mistake when you're focusing only the price, not monthly payments. Again, taxes, insurances, and HOAs has a huge impact on your total monthly mortgage payment. And that's why, again, on a $700,000 house, you may be able to qualify, but not on a $650,000 house. Before to submitting your offer, your mortgage broker should know about that. You should send at least the address to mortgage broker and tell them, hey, can you verify if I will get approved on this particular property? You get the green light, or your mortgage broker will say, listen, you are very close. Just offer $5,000 less, or you will not qualify for $700,000 pay on this house, but you will qualify $680,000. So go ahead and submit $670,000 house and try to negotiate to $680,000. I can get you approved at $680,000. Anything above, if you really want this house, you have to come up out of the pocket the difference, most likely. And you have to make the decision, or at least you know what's your maximum for that property, and you are starting to negotiate. If you can't lower them to $680,000, that's it, negotiation done. The next most common mistakes is underestimating insurance and closing costs. Now, I spoke already about the insurance. It's very important to get good estimate. And your mortgage broker knows and works with several good insurance agents, and they always submit it once they have the deal, and getting good estimates for your property, and they will show you. And you can choose whichever you want. Not always the lowest one is the best one, but that will be your under your discretion. Now, the closing cost is the most common mistake a lot of people make. I haven't mentioned it purposely until now, so you guys have some kind of understanding until now how the process works. But now you have to implement the closing costs into your first step. Why? Because you did your calculation. Remember, on a first step, you like the house. You think from mortgage point, from lender's point of view, you think they will approve you. Don't forget about the closing cost. You have to have a closing cost in your bank account. There are ways that you may structure the contract with the house that seller will pay portion of the closing cost from their proceeds, and it's possible to do it. It's very common. I do it a lot, but there are restrictions. there are percentage that you can only use. Depends how much money you are putting down. That allows on the deal seller concession. And seller concession can help you hours to your closing costs, buy down the rate, all that stuff, but not for down payment. Let me be clear on that. Now, uh, and their appraisal also has very its own say on can you get the seller concession or not, because a lot of times if the property appraises $750,000, your contract is $710,000. You can tell your seller, you know what, let's recontract, restructure the price to $730,000 if the other parts of with mortgage allows you, and give me 20%, $20,000 back as a seller concession. Now, what that does, if your closing costs are $25,000, then $20,000 covers by seller, and at that point, seller already agreed for $710,000 to sell. That for them there is no difference. They will 720, very little difference if they have to pay their agent a fee. They pay that 2.5-3% more for the 20,000, but realistically there is not much difference. They get their money for 710, so they most likely will agree. And they will do the calculation, and he will agree to less amount, whatever the extra gonna pay for the 730 to the realtors. Then they will subtract that, but they will agree because it's no difference for them as long as appraisal comes for you good. Because if it doesn't, you cannot practice this unless the seller decides to lower significantly the price, and which is hardly believable. So you need, regardless, there are ways. What I'm trying to say is there are ways to help you on a closing cost, but you should be prepared to have closing costs. And what are the closing costs? Closing costs are the underwriter fees, brokerage fees, if there is any, title fees, and the most part of the closing costs are the prepaids, because when you are purchasing with the mortgage, and you're gonna have in an escrow account, the escrow is designed for it's for lenders, banks' safety, that the house taxes will be paid on time, the insurance will be paid on time. So they creating a kind of, imagine, separate account where they charge you monthly. When it's due, they pay on your behalf the taxes, and you can be confident it will never be late, because lender protects its money. Because we all know if you don't pay taxes, there is a lien on your house, and before lender can get their money, the taxes has to be paid. So the lenders want to always be the first lien holders on the property. That's why they will pay it. So so those prepaids are very high, because in Florida, especially, let's say your property insurance, if you're buying single family home, is $6,000 a year. So you pay that $6,000 at the time of the purchase for entire year. Now next year you have to pay it again. So we don't know how much it will increase or decrease, but based on today's, it's 6,000. Lender bank will start divided into a month. Every month they will charge you $500. Now, if it's $7,000 at the next year, they will pay $7,000, but they will do recalculation. They will say, now you are negative $1,000. You have to pay this back to us, and that being negative on escrow has no effect on you, nothing on your credit report. Lenders actually willing to take that risk, even if you have next year will go negative, just because it's important for them to make sure the taxes, insurance, everything is paid on time, and they are first lien on the house. So you're gonna pay, imagine this, $6,000. You escrow always, they wanna have 2-3 months of reserve, so that's $1,500 plus the $6,000 for this year, $7,500 just for prepaid for insurance only. Now it depends how much is the tax. If it's $3,000 a year, then you are paying 200. You will pay 2 3 months. So what's the month on 3,000? Let's say it's $3,600 a year. So it's $200 a month. $600. You will pay 2 towers to escrow account for 2 3 months as a deposit. If it's $12,000, it's a $3,000 for just 2 3 months of reserves to have on escrow for the taxes. So the closing costs are very hard to know from the beginning, but you can. It gets expensive. So you can take a calculation. I will tell you roughly if it's $500,000. You probably again depends how much are the insurance, how much are the will be the taxes, but you can have range between $15,000 to $20,000 have a closing cost. Approximately, if it's $700,000 house, imagine it will be about $20,000 to $25,000 range of approx. It could get as high as $35,000 closing cost. So your mortgage broker, once they have the particular property, will be able to give you much more accurate closing cost. However, you should have an idea. If you have only $15,000 down payment, 3% for $500,000, and you don't have any closing costs, now you have to look the houses only that the seller will cover the closing cost. And a lot of times it may not cover the full closing cost just because of the guidelines. If you're doing mortgage, there will must be the 3% of the loan amount, or 6% or 9% of the loan amount, the seller concession, based based on how much money you are putting down initially. So your mortgage broker will explain those into detail. And the last but not least, the one of the common mistakes is choosing the wrong loan. And you are not choosing this loan. Choosing the not correct mortgage broker, good mortgage broker, it may go towards to they will select not the right loan, and it may be delayed, and it may lead to the denial. So it comes to again to the point: choose wisely, choose the right mortgage broker, and have them explain why they're going with this loan option, why not they going to different ones. They should be able to explain, at least give you 2 3 options, and explain why those options are one of the best and which one they think you should go forward, but you have to make the decision. Now, let's move to our last topic for today, today's market and opportunities. You probably heard it. If you're not, I'm telling you right now, the rates are significantly higher than we all used to be. And I'm not talking about 2-3% of the rates during COVID. Those were most likely once a lifetime opportunity. But I'm talking about high threes, below 5%, a range that we very long time used to it. Nowadays, when I was making this presentation, this webinar, the rates were about 6.45%, and they sit higher than they were 2 months ago before the Iran all this situation started, because we were on conventional and FHA loans roughly 5.6, 5.7% range with approved credit, but we were once the whole situation with gas prices, inflation, everything started. Because remember, all these are estimates. There is economy is probably gonna be worst near future. That's nothing is for sure. It's an estimate. The rates may start to lower, and vice versa. So, based on the projections, the rate started to go astronomically fast higher, and we were almost to the point to break against 7% range. Now it's stabilized a little bit. It's lowered a little bit. It's every day changes. Like nobody can guarantee which way it will go, but today's, when I'm talking, it's about 6.3% range. Remember, when the rates go high, they go very fast. When it's time to get decreased, it's very slow process. Now, let's go back to this chart. This chart will tell us you why even being in a higher rate market is beneficial to purchase a home, because there are several leverages you get as a buyer. First of all, you see the house because there is not enough demand, and the demand is not enough because a lot of people, the breaking point statistically is about 5.75% interest rate. Below 5.75%, a lot of people comes back into a market because they can qualify with their salary, with their income, everything. More above 5.75, it puts you in the range where the demand significantly lowers down. And once the demand is lowered, like in today's situation, not too many buyers, the sellers are waiting longer, their houses are in a market longer, so they reduce the price. That's one benefit as a buyer. That's why it's buyer's market. It depends how long it's been in a market. Not only they're reducing, but they're negotiating much lower price. In some cases, you may even today we be able. I saw $80,000 off the selling price on the contract, so that's possible. So you gain there. And also that when the rates eventually comes down, as we mentioned, more demand, more buyers, your property values are going higher. So you will have a lot of equity at that time if you decide to sell. Even if you don't decide to sell, then you can refinance and put all your, if you do not taking cash out, you're doing just a rate and term refinancing, you will be able to get put that into your loan amount, and you need that equity in order to throw those extra closing costs into your loan, so you will not pay out of pocket anything. So that's the process. Now let's look. You are buying today $600,000 house. Let's use 3.5% down payment. Why 3.5%? Because on FHA loans, first time home buyer program, minimum requirement is 3.5%. If you go with conventional loan as a first time home buyer, you will need a minimum 3%, but let's use 3.5%. So at 6.45% interest rate, and I'm going to tell you only the principal and interest because this is what matters. It doesn't matter the home price is 600,000 or 700,000. Taxes, insurance, all that stuff will exist, and it depends per property. And it's most likely, if we talk about one property, will be same. Doesn't matter the rate is 6.45 or 5%. So we're gonna exclude that. We're gonna talk only about the principal and interest because the significant savings are here. And you heard me correct, savings. At higher rate, your principal and interest will be $3,602 range. The basic calculation for 30-year mortgage. Now, if you are the person who is looking to wait for the rates to lower, let's say you waited and you got to the point that the rates are 5%. Good for you. Because more demand, at that time, your property price probably increased. And not probably, most likely will be increased. And in some areas with good schools surroundings, and like, for example, Boca Raton, Florida, just if we take an example, it will be more than $100,000 in some places increase on the property value. So don't be surprised, and it's happening very fast. So I'm using $50,000 increase, which will be golden average. So now the same house you will buy at $650,000. Now 3.5% is $1,750 more. You have to come up out of pocket. Yes, you're closing at 5%, always 1.5% less, but your saving on principal and interest will be about $230 a month. So that $1,750 you paid, it's you paid 5 months upfront already of your saving first, but you lost the leverage. At that time will be very hard to negotiate the price. More demand, sellers are not willing to wait for another offer because it most likely will come. They're not reducing the prices. So you and when, even if you purchase it at 650,000, you don't have any equity. But if you purchase for 600,000, now you had at least $50,000 equity. Now, why I'm putting zero under the down payment under refinancing, and it's the most important part of this subject. Refinancing, nobody takes you away. You can refinance later on and lower your payment. Look at here. I put $593,000. I put about $14,000 roughly average closing cost during the refinance. Yes, you have to pay closing costs, and there are prepaids involved that too. But realistically, you don't pay $14,000 because I'm sorry, what's happened with my screen. Yes, so sorry for this. Yeah, so you are not paying $14,000 because you, when you're refinancing, you will have some money initially on your escrow with another lender, and they will cut you the check and send you back. So let's say you paid, and again, prepaid during the refinance, but you had already $7,000-8,000 on your escrow that the other lender collected your and that they had to pay for taxes and insurance. So you get the check back. So realistically, you have to subtract, and your closing cost during the refinance is not that much. It could be between $5,000 to $8,000 if we subtract. But until you receive the check, you can put that 14,000 into the loan amount because you have enough equity. It will be possible, and you are not doing cash out refinance. And you lock yourself again at 5%. And look at the saving from $600, you're going down to $3,070. That's $530 difference. Saving a month to you. And it's $300 less than if you at the same rate bought the house now. And you really don't have a lot of room, no equity. Even the rates will drop later on at 4%, and you want to refinance, even at 3.5%, your payment will be still more than $3,070. And to see 3.5%, 4% rates, it most likely will take, in my opinion, at least 5-6 years. 2-3%, I don't think we will see at all. So that's all what I wanted to talk today. Hopefully, again, I was able to explain all this in a manner that you guys will. If you didn't know anything about it, now you have a pretty much idea how everything works, why it's better to purchase it today, to take what to take into consideration to see if you can, from bank's point of view, you can be approved or not, your very initial step. And whoever knew some of the stuff, now they refresh their memory, and it's good. Thank you very much. Again, I'm gonna say this just because I'm going to stop the recording. But stay. Whoever can stay, please stay, and we will go live questions. And I will try to answer every single one you guys have. We will have about, I will stay as long as you guys don't have any questions for at least an hour and answering all this. Let me stop the recording and we can start.